Awesome. I see a few people trickling in, but we can go ahead and get started. So thanks everybody for taking the time to join this webinar today. And we're super excited to talk about fundraising. And we have an awesome cast of folks that are here to speak about their experiences, as well as give some thoughts and thoughts about fundraising, thoughts about experiences that they've had working with founders or being a founder themselves. So just to kick it off, to introduce myself, my name is Francesca Puccinelli, and I am on the business development side at Carta. And I've been with Carta for about 4 years now, a little bit over 4 years, if we're looking at exact timelines. And I've really seen the company grow a ton. So seen the company grow from Series B to now Series G. And along the way, I've worked with a ton of different partners and also a ton of founders. So today we'll talk about a lot of the questions that I get often about fundraising and different aspects from the fundraising perspective. So I wanted to introduce this awesome group of folks that we have on the line today. And we'll start with Lindsay Mignano. And Lindsay, we have her from Smith Shaporian Mignano, which is a law firm that's based in San Francisco. And Lindsay counsels national and international startups regarding business formation and expansion into US markets, financing, and contractual matters. Prior to founding her four-person firm in 2016, Lindsay practiced at an international law firm. She also received her bachelor's degree at Stanford and attended UC Hastings College. And let me just switch this screen for a sec, and I'll go back to the legal disclaimer before I jump into the questions. And the next person that we have to introduce is Rebecca Willits. So Rebecca is joining us from Sequoia Consulting Group. Rebecca recently joined Sequoia Consulting Group and has had several years of experience in the PEO space. And at Sequoia, Rebecca works with clients to provide full service competitive benefits, HR, and risk management services to hypergrowth companies. Next up, we have Robert Ravancinas, and Robert is a senior associate at Maven Ventures. He joined Maven in 2015 as the firm's first associate, supporting the investment team's work, backing many of Maven's exceptional entrepreneurs. After joining one of his portfolio companies, he's back at Maven as a senior associate. He's exploring new areas of opportunity in early stage consumer software and meeting and great entrepreneurs building ventures to tackle them. And last but not least, we have Glenn Gao. And Glenn Gao is a CEO of a CEO coaching group and a venture capitalist. Glenn started his career as a software developer and went on to become the CEO of a consulting firm, consulting companies such as Apple, Google, Facebook, and Microsoft. Today, Glenn coaches CEOs and has been deemed the CEO therapist, helping CEOs succeed and achieve happiness at the same time. Glenn is also an expert in AI at the board level. Awesome. So before we begin, just a quick disclaimer from Carta's legal team. This communication is on behalf of eShares Inc., DBA Carta Inc. This communication is not to be construed as legal, financial, or tax advice and is for informational purposes only. This communication is not intended as a recommendation, offer, or solicitation for the purchase or sale of any security. Although this presentation may provide information concerning potential legal issues, it is not a substitute for legal advice, and any opinions or conclusions provided in this presentation shall not be ascribed to Carta. Carta does not assume any liability for reliance on the information provided herein. Awesome. So just to kick it off, the first question that we have is really about preparing for a round. So what does it look like from that prep stage before you've actually got a term sheet in your hands? What do you need to have in place prior to that round? So Lindsay, this first question is for you. What is a typical raise size for a seed stage, Series A company, or a Series B company? And as a follow-on to that, what are some trends that you're seeing in financings today?
Excellent question and quite relevant in this market. So I own a small for women and minority owned corporate law firm for early stage startups. Most of our clients are at the pre-seed, seed, Series A, and some at the Series B level. Our bread and butter is financing commercial contracts and M&A work. So we do see quite a bit of financing, especially in a frothy market like this. Just to set the parameters, I define, and these definitions can vary, with countries or states, but I define a pre-seed as anything under 500,000. It can be done via SAFE or convertible note. It generally includes something like a family and friends or an angel. Every once in a while, if you have a pre-seed venture funds, it can include people who are putting in 250 at the pre-seed level as well. I did take a look at the NVCA Q2 report for the first half of 2021. We've seen the highest figure of angel and seed investments for any half year in the history of the NVCA data sets. There was 1,733 deals closed in Q2 alone, which is a really frothy market for the pre-seed and seed. Seed I define as anything from 1 to 5 million, and seed rounds can be multiple. The median seed round in Q2 for the Entrepreneurs Report was about 2.9 million. This is consistent with what we're seeing in our office as well. At the 2 million, 3 million mark, we're really switched from note rounds to Series Seed preferred rounds or price rounds. There's generally a slight, to say the least, increase in price for legal and accounting at that point. So we normally don't see a price round until that amount becomes, again, 2 to 3 million. Series A can be anywhere from 5+ million all the way upwards of 20+ million. It's very industry dependent. The Q2 Entrepreneurs Report put the median at Series A at 12.5 million. The NVCA Q2 report said that the median average early stage deal size in the first half of 2021 was 9.5 and 20.5 million, which was way above and over 2020's numbers. And we are seeing at our firm, just anecdotally amongst our clients, a number of seed companies who are raising Series A right now, and they are putting out requests for 7 million and getting back term sheets for 20. So it's a really frothy environment. It's a great time to be an early stage entrepreneur right now. We're really excited to watch all of that trajectory in 2021.
Thanks, Lindsay. And just a quick note, I see some questions popping in the chat, which is awesome. And we'll get to the questions at the end of all of our questions that we have prepared today, just as a quick note there. And one other question for you, Lindsay, just regarding the different terms that you're seeing. Are you seeing anything out of the ordinary? Are you seeing any specific trends from the terms perspective? Maybe thinking even from the convertible note and SAFE rounds, things like pre-money, post-money, anything that is coming up more often in this market?
Right. So generally speaking, if you look at the trends statistically as well as anecdotally in our firm, we're seeing more deals being done outside of typical venture hubs like San Francisco, Silicon Valley, which invites firms that may have not necessarily historically invested in technology companies and startup companies. So with deals coming out of Houston, where you're having family offices with oil and gas money suddenly entering this space, or sometimes in other places that are not typical venture hubs, you will see some interesting asks. For the most part, though, what we've seen standard asks only because this is an entrepreneur's market. The SAFE or convertible note will usually have a side letter if at the pre-seed stage or the under 2 million, 3 million mark stage. We haven't seen too much deviation from the typical information rights, maybe pro rata rights, every once in a while super pro rata rights that we would normally see. No one's really been asking for board seats at that stage still, unless we're talking, again, non-traditional investors who are entering the market where they may not have a firm grip on what is normally asked at a certain stage. But because it's been the opposite of 2020 for the early stage, with 2020 being such a later stage startup market and 2021 being a really actually very frothy early stage market, most of my clients are really finding they're lining up their own investors, they're bringing them to the finish line. They've got all these horses in the race, and they're going to choose and cherry pick the best investors with the best terms for them. This has been quite a long time coming. We're really excited to see this kind of traction, and it really does put the entrepreneurs with some leverage to avoid having giving up too much for too little. So I would say I haven't seen anything out of the normal because of the frothiness of the environment.
Makes sense. Super helpful. The next question, kind of thinking more so from the investment perspective, Robert, when you see folks that are preparing for rounds, what will you as an investor typically zero in on during the due diligence? And also, what is super crucial for companies that they need to do prior to raising to set them up for a successful raise?
Yeah, great question. So my firm, Maven Ventures, we invest at the seed stage. And when raising a seed round, I'd say across most investors at this stage, the two most critical filters that they're thinking about are the vision that the company is going after and the team. And when it comes to the vision, what we're diligencing is this a product that really needs to exist in the world and will improve consumers' lives at scale? And so when we're diligencing that, we're looking at the competition, who's funded in the space, how are they doing, how is your solution play in that competitive landscape? And so as far as what to prepare as an entrepreneur at the seed stage, I'd say having a great sense of the landscape of how your product fits into that is very critical. And then I also mentioned the team. So for us, the team is super critical at this stage to understand how do they gel together, how did they work at their previous companies. And so we do a very extensive set of reference calls with folks that know the founders that we're investing in. So the other thing that I'd recommend founders go into a fundraise having prepared is that list of references that they plan to offer to an investor should they get to that level of diligence. And though vision and team are the two most primary things that we're looking at, I'd say the kind of next layer that we're going to diligence is the product, the customers, and the metrics. So the product, we're using the product, we're having people that might be potential customers that we know use it. And so just understanding how the product works. Customers, if there are customers that are using it, we'll talk to them, we'll kind of back channel with so-and-so that's used it. And then as far as the metrics go, we're looking at engagement and retention. So, and I guess the basic things like user growth, number of users, but also getting that second layer of how often are they using it, how often are they coming back, when do they churn off the platform. So as far as another thing to prepare in advance of a fundraise, I'd have a really good handle of what does your user base look like and what kinds of metrics can you use to support a narrative that this is something that is a beloved product by your users.
That's awesome. Thanks, Robert. Yeah, I think definitely super important to have your metrics in place. And also coming from a cap table management company, I'm sure the cap table is also hugely important in making sure that that's very tight. We're seeing a lot of folks definitely taking their cap table into account from the investor perspective, for sure.
Yes. Just to chime in on that, because that is something I forgot to mention. When I spoke about the team dynamics and how it looks from a cap table perspective, as well as the cap table overall, is definitely something that we diligence because we want to know what the dynamics are going to be amongst the team. Are they incentivized properly? Are the critical people incentivized properly? Is there a ghost co-founder on the cap table that has a big chunk of the business that's not around anymore? So thanks for bringing that up. That's for sure something that we look at, and it can make or break a deal for sure.
Awesome. Thanks, Robert. Next question is for Glenn. So you're a CEO coach, also deemed the CEO therapist. And when you're talking to CEOs about their pitch and pitching to investors, what are some tips that you offer to these folks that really can help them elevate their pitch and really can help them communicate their product to the investors?
Thank you for the question, Francesca. In any pitch, the first thing to think about is the audience. And what does the audience want? So companies often have a sales pitch deck. They might even have an employee pitch deck for potential employees. When you create a pitch deck for investors, you need to understand those investors and what they want. First, you want to get to know the potential investors. What I'm telling you is that you want to customize your presentation based on who you are presenting to. When do these investors tend to invest in companies? At what stage? What is a typical check size they might write? What types of companies do they invest in? You want to know this going in. You really want to understand your audience. Secondly, you want to get to know the mind of the investor. The biggest mistake founders make when pitching to investors is they talk too much about their favorite thing, which is their product. I have some bad news for you. Most investors don't really care about your product. What they care about is the value of your stock today relative to what they think it's going to be worth. This is a story about the company, not the product. You need to tell a story about why your company is a great investment, not how cool your product is. Your product is only one part of the story. Convince the investor that the problem you're solving is so important that prospects are going to pull your product out of your hands. Convince them that this problem is big today and it's growing. Convince them that people will spend good money to solve this problem. Finally, tell them about you and your team. The team is often the most important part of the pitch, and the CEO is the most important part of the team. An investor is imagining writing a check to a person. The investor needs to believe that that person, the CEO, is going to make magic happen. Prove to them you can do that.
Thanks.
I'm offering a complimentary coaching session to CEOs. If you're accepted, you'll receive a one-on-one coaching session with me at absolutely no cost or obligation. Due to my current commitments, I'm only able to accept a modest number of requests for coaching. During the coaching session, we'll immediately go to work and address your highest priority challenges. You will walk away with ways to begin solving your biggest problems. And you'll get a sense for whether or not we're a fit for each other. To see if you qualify for this coaching session, visit the website currently showing on your screen, or click the link in the description below. Thank you.
Glenn, I think that also tied in very nicely with what Robert was saying about, hey, the team is what many VCs are optimizing for. The team is crucial to the success of the business and the company. So I think those two, the questions were planned, but this connection wasn't planned. So that's awesome that we had that reinforcement for sure.
Yes. Yes, and I do like to jump on Robert's bandwagon, and I do want to point out that, look, most companies are going to pivot, and so if you're going to pivot, that means you might go after a slightly different market, you might go after or build a slightly different product, and the thing that stays steady, hopefully, is the team, and that's what investors are really betting on. Awesome,
thanks, Rob. Great. So the next part that we'll talk about is, okay, we've talked about the prep for the round, we've talked about the pitch, and the next thing that we really want to hone in on is the execution. So let's just say you're about to go into a pitch meeting with that investor, about to sign a term sheet. But Robert, this question is for you. When you're evaluating these startups, what factors are you prioritizing? Maybe you can dig a little bit deeper from even the consumer side of things. And how have those evaluations changed because of COVID? And what do you anticipate will remain the same versus a hopefully in-person world of 2022?
Yeah, so the way that we invest at Maven is we have several consumer trends that we believe will change how people live their daily lives, whether it's accessing their digital health or communication or transportation. And so we're looking to invest in businesses that have major tailwinds as far as how society is shifting. And so COVID naturally was a time where the way that we lived was overnight changed for everyone in the world. And so at the beginning of COVID, we started to invest in businesses that were facilitating that transition to a more digital world, whether it was Glimpse, that was one of our portfolio companies that's doing round robin chats for college students that can no longer do their Greek life organization rush on in person anymore, and Luma, which is an online community platform. So we started investing in things that had those kind of macro tailwinds. And as we hopefully soon emerge out of this COVID time, we'll get back to, you know, a different set of businesses that have different trends behind them. And the other thing I'll mention is we have been investing a lot in Zoom at Marketplace platforms, which there's going to be a Zoom app store. If you have the updated version of Zoom, you can see apps there, which was a belief that as people are on Zoom more, there will be an opportunity for these apps to get a ton of distribution. So I guess the point that I'm trying to make is that investors are looking at whatever the trend is for the time and investing in platforms that benefit from those changes and how society is moving. And the last thing I'll mention that changed because of COVID that I don't think will change after the fact is that we used to invest mostly in Bay Area founders. Now everyone's on Zoom anyways, and so we've geographically moved way more diverse, and I don't expect that to go back to how it was before. We'll continue to be more geographically agnostic than we were pre-COVID.
That's awesome to hear. And I think you may have mentioned this a little bit before, but I think one thing I hear often is when you're going into a conversation with an investor, know what they're investing in. So this is a great chance for anybody that's interested in Maven Venture. You know what they're looking for. And I think doing your homework about that investor and about the companies that they're investing in really goes a long way and shows that you're committed to learning about them and really working towards this partnership. Awesome. So moving on, Lindsay, this question is for you. And I'm sure you've seen, especially in 2021, all of the law firms that I talk to say that they are so swamped. But what can speed up a deal and what can slow it down? And as part of that, in your opinion, what should a company have in place to ensure that a smooth raise occurs?
Great, happy to take on that question. All right, so I've seen some questions here in the Q&A. I'm going to try to answer as much as I can and incorporate this into my answers. One of the first things that happens that always slows down a deal is your incorporation documents are not really prepared for VC financing. And we're seeing a lot of clients who other non-VC hubs who may be formed as state LLCs who need to convert to a Delaware C Corp for venture investment at the 11th hour. So conversions can slow down a deal. Conversions, actually, the work is rinse, wash, repeat. We do like maybe 5 a week because everyone's raising right now. It takes us like 4 or 5 hours, which is like $2,000, $3,000 just because we bill at like a rate that's like half or a third of what big law rates are. So like it's quite cheap to do. I don't know why people wait so long to do it. I think it's because they're trying to achieve the pass-through benefit of this aspect, but you can still achieve it by being a Delaware C Corp, filing an S election, and revoking S election before venture financing. So it's really somewhat, I think, misinformation or startups going to like small business lawyers and setting themselves up as small businesses and not as to be venture funded companies. So that is one thing that slows the deal down. A tax analysis, the time it takes for valuations, international tax analysis, transfer pricing analysis can also slow financing down when we are flipping companies for rates. And so one of my big areas of practice is I take international companies from Europe or Australia or New Zealand or Canada who have maybe raised like anywhere from 1 to 2 or 3 million abroad, and we're going to flip them, or we're going to do a Delaware flip so that we can make their parent company here a Delaware C Corp and their abroad company a wholly owned subsidiary for a venture raise. That is a very cumbersome, very expensive process. It involves a lot of coordination with lawyers on both sides of the pond if we're talking Europe, as well as international tax analysis in terms of transferring that IP from Europe or whatever home country, mother country it is, to the US. And then finding that transfer pricing analysis back to license it back to sublicense. So it takes a lot of time. That can also slow down a deal. Having that done in advance is pretty critical in terms of us speeding up deal prep. In terms of other things that kind of slow things down at an earlier stage in Series A, or, again, inexperienced investors who do not regularly invest in tech. 33% of deals, again, took place outside of typical venture hubs. We tell all of our clients to vet carefully their investors, because this can be an 80-20 problem with an inexperienced investor who does not regularly invest in what you invest in or what you are marketing for your services or product, and who has demands or that are unreasonable. So really, having a clear and set process to find investors who do invest in what you do, who are knowledgeable about the space and who have good terms for you, can also be really critical. Last but not least, and I hate to say this because I love to tell founders to DIY where they can, but this is one where you shouldn't. We have a lot of founders who make DIY at the term sheet stage, might promise things that are actually that they don't really quite understand. And then they come to us after the term sheet is signed and we're drafting up that investment agreement, if it's a Series A, or we're honing down on the side letter terms if it's less than 2 or 3 million, and they realize they didn't really understand what they were negotiating. And that can be really hard to backtrack from and can really slow something down. Things that speed the deal up, and this is not a plug for Carta, but it really does help. Can you please prep your legal and accounting before the 11th hour? Like, it is something that all lawyers will ask you to do. I know you're going to do it. You're going to try to double track it so that you're doing the raise and the cleanup at the same time. But due diligence is real. Like, we need to review those documents, make sure they're legit, they're prepared the right ways, figure out if there are any ghosts or weirdos on your cap table who you have no connection with anymore. We need to do that, especially if you don't form with us before we actually give those documents over to the investors. So having your financials and your legal in place is really key. Sounds self-serving, but it's actually one of the things that can actually slow down a deal, whether it's an acquisition or a financing, and it happens, all the time that you guys come in so late for that. The current market is really frothy. So deals, if you have your legal and accounting in order, just the nature of the market, the competitiveness of the market should just speed up your deals. You can see deals closing within a month or 2 months or even less from the time a term sheet arrives on the door. And that's really, really fast in my opinion. But we are seeing that. And then obviously speeding up along the lines of getting legal and accounting in order. Again, investors who know what the typical terms are and what the typical asks are at the various stages in which they're investing, whether it's pre-seed, seed, Series A. And there was a question about whether or not we're seeing still multiple seed rounds. Yes, we're seeing avocado rounds. We're seeing multiple seed rounds. We have clients who have raised seed 1, seed 2, seed 3, and then gone for A. And we also have clients who have raised seed 1 and just straight went to A or just went to A. So it's variable, but having that investor be knowledgeable, what's typical in the industry, to ask for at various stages is really, really key in terms of making sure that that's a solid investment and that makes it go a lot faster.
Thanks, Lindsay. That was awesome. You brought a lot of intel to these founders, I'm sure. And just wanted to address one question that was in the chat, but it sounds like there is, and I see it as well, but what about a Delaware LLC? I see those come up every so often. I'm sure you do as well, but would you mind explaining the differences between a C Corp and maybe even explaining, how the incorporation process works? I think that would be helpful as well.
Sure. We have a lot of Delaware LLCs that come to us for conversion. You can absolutely raise money in an LLC. That is not impossible. The reason why people come to us for conversion to a Delaware C Corp is really venture or private equity preference. There's 2 preferences going on here. There's Delaware, which is pretty much the gold standard. It's got really good case law, an excellent Delaware Secretary of State processing time can be 24 hours. The Court of Chancery has tons of opinions that we can all look up and find easy answers to business dispute questions. It's generally favorable and easy to understand from a founder and from an investor perspective. So that's why Delaware. The second prong is why a C Corp? Why not an LLC? Why not an S Corp? And people like LLCs because you can pass through profits and losses. So that's something that people really enjoy. And that's why a lot of entrepreneurs form as LLCs. Makes total sense logically. Again, the reason why they convert is because of venture preference. They want to attract venture capital firms. Venture capital firms are usually also organized as LLCs or LPs if they're funds. Somehow tax-wise, and I'm not a tax attorney, so I'm putting this out, it's not a tax advice thing. They prefer the Delaware C Corp. That money transfers better tax-wise in some ways. And they just generally prefer it as a preference. So if you're not raising venture financing, you're just raising from angels, it might just be fine to stay a Delaware LLC. And like I said, it's not a hard and fast, must do. It's just a preference. So most people do convert. If you convert and you still want the pass-through benefits of the LLC that you previously had, but you have to be a Delaware C Corp, what you can do is preliminarily file an S election. It's limiting. Obviously, you can have not more than 100 shareholders. You can only have one class of stock. Everyone has to be a citizen or a resident. It can't be like an LLC fund. But you can have that in place until you raise monies from an LLC fund or an institutional investor. And you can just revoke it with the IRS prior. So you get that tax-free benefit that the LLC has, but you also have a corporation as the shell. So that's something that we see clients also do, but predominantly the more of the conversion work that we're seeing these days is stateside LLC, whether it's New York or California, or Oregon, Washington. The company decides it doesn't want to be a small business. It is targeting venture investment funds. And now the venture capital firm is asking them, what's up with this LLC? We want you to be a Delaware C Corp. And that's sparking the reason for conversion.
Got it. Thanks so much for that answer, Lindsay. I think that was really helpful, and I'm sure you could probably spend hours talking about the differences between the two. So thanks so much for giving that answer. So switching gears a little bit, this question is for Robert, but in the early stages of fundraising, it's almost inevitable that the founders will be diluted unless they're bootstrapping. So in your experience, what is a typical dilution amount or a typical dilution target for founders? And should this be a factor as they're planning a raise?
Yeah, so I'll answer the second part first. I think it should absolutely be a factor for two main reasons. First of all, for yourselves as founders, you want to make sure that you have a plan to continue fundraising and without diluting yourself down so much when it's all said and done, that your incentives to continue with this business are minimal. And with the raising venture capital money, it's inevitable that there are going to need to be subsequent rounds. Once you tap into that funding source, the investors are going to want you to raise an A and a B and a C until you have an exit. It's rare from my experience that someone raises an initial venture round and to continue down the path of it. So it's definitely important to think long term and have your own dilution in mind. And then the second consideration is that investors will look at that, as I mentioned earlier, around the cap table. We as investors want to know that there's going to be enough skin in the game for you as founders, but also as subsequent investors want to come in, it's not going to deter them from wanting to put capital in. I mentioned a ghost co-founder earlier. We've looked at businesses before where there's someone that's not involved in the business that has a disproportionate amount, and it just makes us think, how is this business going to get capitalized for several more financings until it can have a massive exit with what the cap table looks like right now? So absolutely important to be conscious of it. And then as far as amount, I'd say that most rounds are getting diluted about 20%. If it's a seed round, we'll put in what I've seen in my experience, kind of a $2 to $4 million raise at a 5 to 25. I know that's a large range, but that's kind of the nature of the market, 5 to 25 valuation. And so companies are giving kind of 15 to 25% up at that stage. And that tends to be the pattern with each subsequent financing. Series A investors are looking to write their check and get that 15 to 25% of the business. And so as you model out what kind of capital you will need to raise to get to your exit, I would just think about each round and the dilution you'll need to experience to get there.
Awesome. Thanks, Robert. I think that makes a ton of sense. The next part of our discussion is, let's say you got that check in hand, money's in the bank, and you want to start deploying that capital. And this question next is for Rebecca, who is from Sequoia Consulting, group. And Rebecca, one of the first things a company may think about after a round is hiring. So how do you help your companies and ensure that the company's benefits package is competitive to their peers and is used to attract and retain that top talent? And the second question is, when does it make sense for companies to engage with an HRIS system, a PEO provider? And I know you have a slide just to help visually, so let me go ahead and share that.
Yep, great question. And as you pull that up, that this is something that we would say is definitely one of the top factors an employee is looking at when they're evaluating companies to work for, but also companies that they want to stay with as well. So the first thing that we kind of start off with is the core benefits package, and that's your medical, your dental, your vision, your life, your disability. And when it comes to medical, we see typically the first plan in place is what's called a PPO plan. We see about 97% of employers offering a PPO, and usually about a 250 or a 500 plan. At Series to C to Series A, B, the average that we see from a contribution standpoint is about 95 to 100% coverage for the employee, and about 60 to 70% for dependent coverage. When you start to grow, you can bring in more funding, you get to Series B, C. That's when we see the changes in the contribution, typically to about 94% for the employee, and then around 95 or 75% for dependent coverage. The reason we see dependent coverage start to go up is because as companies grow and they start to scale and hire more employees, they're bringing on more dependents as well. So we want to make sure that they have that coverage there also. The second plan to kind of add in is what's called like a high deductible health plan. This is a great low premium option for employees that are maybe not high utilizers. And we see about 75% of employers offering a high deductible health plan. Now, the level of coverage mimics the same of what you'd be doing with like a PPO plan. But one thing to point out is that employer contribution to a health savings account. So we usually recommend that when you're offering a high deductible health plan and have a health savings account in place, to contribute about $115 a month to the employee and about $230 a month for the dependents. And then lastly, always kind of sprinkling in like a Kaiser HMO type of plan. Reason being is because we tend to see that employees that are on Kaiser today, they love Kaiser and they want to continue to utilize them when they change employers. So we see typically adding that as well as kind of that third option and continue that as also. And then on top of that, again, having the vision and dental, life insurance and disability. Typically we see about for basic life insurance, about one-time salary. For short-term disability, sometimes short-term disability is foregoed at the early stage startup area, but as you tend to grow and secure more funding, we see that kind of added back in. But then for long-term disability, we see about 60% of salary with a max of benefit of about 10 to 15,000. But the big thing to kind of point out is that it really is it's more than just medical benefits now. When it comes to well-being, from physical, emotional, financial, and family support, we see companies starting to contract with vendors like a SoFi or a Spring Health or an Aptiv to really provide well-being services to those employees and to their families. And then paid family leave. I would say this is definitely one of the most valuable things that we see a lot of candidates asking about is paid parental leave. So this is our first recommendation that we give when you've secured a round of funding and starting to ramp up with the hiring as well. A big component too is DE&I. There are things that you can do to promote DE&I that won't cost the company much money. The first thing is, as your company becomes more established and you're securing funding, you just start thinking about, are you establishing mission statements and do they reflect the company's values? Make sure to proactively be looking at your hiring practices, and which is something you can even do before you even secure a round of funding, and make sure that you really meet those demographic splits, especially for those in leadership. And then training programs, having those in place, such as unconscious bias and unbiased training, being able to offer that during your onboarding program. So this is something that you can be able to talk about with candidates that can really go a long way. And then other components too, such as retirement. We definitely see groups offering retirement. Now at early stage, we don't see typically the employer offering a match, but as more secure funding comes through, then usually we recommend a match to come in at that point. And then infertility support, we see partnering with vendors like Carta to offer infertility services or maybe health reimbursement accounts as well. And then other components too, like pet insurance. Pets have become people's families, and so people make sure they're taken care of. And gym memberships was also something that we would see a lot of candidates asking about, pre-COVID as well. But going back to your second part of the question of when we're seeing companies bring in a PEO provider. So once an SMB startup has secure funding and they become an employer, right? You're hiring and you're starting to scale. Usually have two options as an employer. One is you can go out and get a payroll vendor, get a workers' comp broker, find a business insurance broker, get a benefits broker, maybe bring in an HRIS system or a 401k vendor, or you can make it really simple and have a PEO handle all of it. So the reason that we see SMB startups as low as 3 to 5 employees through to Series B and C bring in a PEO, which a PEO goes for professional employer organization, is for a few really key reasons. Number one is, a PEO, we're able to actually aggregate clients together to create a large buying pool, which will then give these clients access to Fortune 500 benefit packages that they otherwise wouldn't have access to in the open market. So similar to the total benefits package that I just spoke to, it's really benchmarked to attract and retain top talent, while also kind of leveling the playing field against some of these larger tech companies. Another component is risk. PEOs actually help protect a business. No founder that I've talked to, tells me that they got into business because they love being an employer or managing employee administration. Being an employer inherently brings baggage and liability. Keeping up with all the changing compliance laws and regulations, all the administration behind it. So what we do is we share in the risk by being sharing the risk of being an employer, and we actually help manage that back end HR, employee administration, and kind of shift the liability to the PEO, really acting as the HR administrator and support for any state and federal agency, so that the founders and the team can really focus on what they do best, and have the PEO kind of helping on the back end, making sure that all things are really just kind of kept in order. Another area is access to expertise. In a PEO model, usually you and your employees get access to HR experts around payroll, compliance, benefits, HR, and really they become kind of an extension of your business without having to increase headcount. And then lastly, where we see, startups, especially in the SMB space, really look at this is, from a consolidation of vendors and having, a streamlined technology to, manage the employee lifecycle, but also have just a better HR, administrative and employee experience as well.
Thanks, Rebecca. I think that, working at Carta, I think us and many of our HRIS and PEO provider partners think very similarly, in the sense that you probably want to focus on running your business after raising a round. So hiring somebody like a PEO provider such as Sequoia Consulting Group will be extremely helpful, so you can focus on the stuff that matters in running your business. Not that PEO provider doesn't matter, but you can kind of outsource that a little bit. The next question and final question before we open up for Q&A is for Glenn. So, Glenn, you and I talked a little bit before this, but when folks actually raise a round, the role of that startup founder may change, and they may have to pivot very quickly to manage a variety of new roles and responsibilities as they build out their team. They're bringing on a PEO provider, they're bringing on new software, and bringing on new people. So as you think about this new role that the founder may have, what are the top tips you would tell this founder to be prepared after a successful raise?
Thank you, Francesca. First, I want to start with a story. I coach CEOs for a living, and in one of my very first calls with a CEO who was running a successful company, had raised a big Series A while ago, in our very first call, he says, "Hey, Glenn, guess what? I just got fired today." It turns out that CEO turnover is actually much higher than we recognize. It's much higher than most CEOs realize when they step into this journey. So I want to talk just a little bit about how the CEO needs to actually change their role as they raise money. When the CEO first starts, they do everything. They write code, they hire a founding team, They make amazing things happen without money, and they go raise money. So when you do your first initial raise, now your role starts to change. Now you have some funding and you have to deal with those pesky investors. Not too much, but you have to keep them happy. And all of a sudden, that's a new skill set. You have to continue to hire. You have to get deeply involved with your product and your product market fit. You start to drive company meetings. You create the work environment. Next, you raise your first Series A. And in many cases, suddenly, you're a minority investor. Now your investors are your boss. They can fire you, like that CEO that just got fired on our very first call. Your interactions with the board become paramount, and now you need a new skill set. How do I manage the board? The pressure turns up a lot. You have to teach your team now how to hire people. It's not just you hiring anymore. You have to identify key company weaknesses and address them quickly. And culture suddenly feels important. Then you reach what is hopefully the final stage, which is scaling. A whole new set of skills come into play when you're scaling. I remember when I was a CEO, I suddenly saw a person who was working for me who I didn't know. And all of a sudden the question comes up, wait, I'm paying them a lot of money, but am I getting value out of them? Are they producing? And you now realize that you need to understand everything that's happening in the organization through your management team. And what about that management team? All of a sudden, I have to work on aligning the management team on strategy. This is a new skill set. How do I ensure everybody's moving smoothly in the same direction? Then things start breaking. I, as the CEO, keep getting pulled into things I shouldn't be involved in. How did I get here? All of a sudden, you recognize that you have challenges and problems that you didn't anticipate having, and you want to delegate those to people, and yet you can't. So again, a new set of skills. Are the people that I hired in the early days the same people who can get us to the next level? Often that's not the case. So what do I do about that? The point here is that in each stage of growth, the CEO's role needs to transform. The CEO needs to build new skills in order to manage a company through its growth. So just want every CEO here to be highly aware of that. Turnover is high and change is paramount. And I wish you all tremendous luck as you scale. Thank you.
Thanks, Glenn. I think that's super helpful advice. I think, being a founder at an early stage company versus being a founder at a later stage company are completely different roles. So it's a matter of growing with the company or having the foresight to understand what's best to the future success of the company, for sure. Great. Well, that is it for the scheduled portion of questions that we have today. And we can jump into some of the questions that we had coming into the chat. And thank you so much for all of the amazing questions. This is awesome. Maybe we just have a full-blown AMA Ask Me Anything at some point. But one question, I'll just kind of go in the order that these questions came in. And then for questions that didn't get answered, we'll be sure to flash this to the panelists and get you all an answer if your email was associated with the question. So one of the questions that came in early on is, how important is financial modeling when raising? So maybe Robert or Lindsay, maybe this question is for either of you that can help answer it.
Sure. So again, this is one of those things where I'm a lawyer. I don't do financial modeling. We routinely refer our startup clients out to experienced CFOs who can help. Additionally, Carta's, plugging Carta, has a section in their Carta launch for our startups, at least I can see it, where you can play with the financial modeling on the Carta website. A lot of times my clients use their CFOs for that. I want to always warn people who are on the call why you don't have your lawyer doing accounting work. Number one, we're really expensive. So do not pay a lawyer to do financial modeling and a lot of those sorts of things when you could pay a very well experienced CFO at like 1/4 the cost to help you with that. A lot of it's a math game. There's no need for a lawyer to necessarily do all of that. Obviously, if you have questions about terms, that's one thing. But doing a math game with me is the biggest waste of your money. I didn't major in math, and I went to law school to avoid math. So please don't. That's the one thing I will say, that you should absolutely start doing that as soon as possible. I refer my clients out to experienced CFOs the minute they tell me they're going to raise, because I know if they've been doing their bootstrap, bookkeeping, that's not going to look great on the record. If they've been filing their tax returns themselves or handling it themselves, there's going to be a lot of cleanup work. So getting that prepared way before due diligence, and getting a CFO involved who can help you with financial modeling and help you figure out how much you need to raise, why you're asking for a certain cap, what your current valuation is, all that stuff is super important.
Awesome. Thanks so much for that answer, Lindsay. And this next question is for Robert from Daniel. What do you like to see if the company does not have current customers because it's very capital intensive to deliver to the first customer? So sort of sounds like the chicken and the egg problem.
Yeah, we've invested in capital intensive companies that don't have customers before. So it goes back to the comment I made earlier about the importance of the vision and the team. And so we've invested in cruise automation before it had any customers. When they were building self-driving cars, we invested in wild type salmon, which is creating lab grown salmon, which doesn't have any customers yet. And so those are just two examples, but in both cases, as well as all cases that we've invested in pre-revenue, pre-customer products, it's about if the founders can execute on creating a self-driving car or creating lab-grown salmon, is that going to change the world for the better and be a massively used thing and a huge innovation? And in the case of both of those, the answer was yes. If we suddenly don't have to rely on salmon farms or fishing, that is an environmental impact, positive impact. It could be better for consumers, healthier, it could potentially be cheaper down the road. And the teams that were building both of those products had major expertise and credibility in building those. So to kind of tie it up in a bow, I think you have to sell a narrative and pitch a narrative that shows this is the product, this is why it has major tailwinds, this is why it'll change the world massively, and this is why we're the team that's going to execute on it. And if you can put that together in a succinct pitch, that supersedes having customers if it can be delivered properly.
Awesome. Thanks, Robert. All right. The next question that we have, this is for any folks that want to answer from the group, but when or how much should a pitch discuss problematic issues such as debt, various struggles in an emergent industry such as the cannabis space?
I'll jump in.
Glenn, I see your hand raised.
I'll jump in. You should discuss those immediately and upfront. And the reason for that is the investors are going to know, or they're going to discover quickly, that there are issues with the industry or even with your company. And you reveal them up front so that for the remainder of the presentation, they can pay attention to your story. If they're thinking in the back of their mind, oh, cannabis, and we have all these issues, I'm not sure I'm the right investor, they're not going to pay attention to your pitch. But if up front you say, here are the issues that you need to be aware of, now let me tell a phenomenal story, you're going to get a much better chance at getting them to want to invest.
Awesome. Thanks for that, Glenn. All right. Next question. 5-year projected ROI or return on investment levels that investor want for pre-money ventures. Anyone want to jump in for this one? This can be one that we follow up on as well. Sound good? Okay, cool. All right. In doing your homework to learn about a VC, is it generally sufficient to visit their website to learn about them and their portfolio companies? Or what sort of, I should say, almost like reverse due diligence should the founders do from the investor perspective?
I think that is mostly sufficient. Understanding the portfolio, how you fit in, how you can, as I mentioned earlier, craft that narrative to and you want to be genuine to who your company is, but it's important to play to your audience and understand what investments they've made in the past and how what you're building, what interests them is fitting into their thesis areas or interest areas. Understanding the person you're speaking with, like for example, if you were speaking with me, looking at my LinkedIn and knowing what company I was at before Maven and how you can riff on the parallels between your company and that company. So I think it's just good to do your research on someone when you're pitching them, to understand their stage, their sector focus, their backgrounds. VCs have to fundraise as well, and when we're going to LPs to raise our funds, we do similar diligence. So I think it's absolutely critical. And
Thank you, Robert. I want to jump on what you just said there, and I agree with much of what you said. In addition, I think it's important to go deep. One of the things that I like to say is that venture capitalists are pattern matching machines. What we're looking for are similar stories, comps, if you will. And if I've invested in something that looks kind of sort of like what you're doing and I've made money doing it, I'm going to be a lot more interested than if you bring me an idea that is completely out of my understanding and I have to learn from you. So you really want to understand the mindset, like I said, of the investor. And you can find this information way beyond what's on the website. And I would encourage you to do a lot of research before you walk in.
Awesome. Yeah, I think one interesting bit of advice that I've heard from folks in the market is VCs are human too. They want you to be able to, show that you did your research on them as a person as well, and really understand who they are and where they're coming from. And I think that way you can be able to build your pitch to help them understand that, hey, I recognize that you're another human, even though, we might be over Zoom. I think that something like that is extremely helpful and really makes it a little bit more personable. Okay, we probably have time for one more question. Just going through here. This question I thought was really interesting because it is about angel investors. So what is your thoughts on angel investors and kind of going into these different angel investor communities, pitching? And the other question, just kind of building off of some other things that I've seen within the question and answer portion, is what do VCs think when you're raising maybe your seed, your Series A round? What's your thought on investors, and what's your feedback to companies that may have a slew of angel investors on their cap tables? Any thoughts there?
Is that one for Robert or is it one for me?
The group. So anybody that might have an answer to that one. Maybe Lindsay, you want to jump in?
I'll take a legal angle quick, but then I'll pass to Robert as to just the number of angel investors and whether VCs care about that. I think he's probably in a better position, or maybe even Glenn, to weigh in on that from the VC perspective. So from a legal perspective, most of our clients do have angel investors at the pre-seed stage. That's how they get their initial money. Sometimes, and more recently, we've been seeing them use RUVs or SPVs to gather all their angel investors and have that one line item as opposed to like 20 line items. Carta, I've been referring a lot of my clients to tell their investors to go to Carta for the SPV fund formation. It's essentially like forming an LLC. To pool all your funds can be very expensive, and if the size of the fund is not, really huge, maybe doing a SPV or RUV, roll-up vehicle, online is a better option for the angel investors. I have attended Keiretsu Forum and other types of Bay Area Angel Alliance and other things. And as far as angel investors, I think this is like one of those things where I keep going back to, please use experienced investors, because there are a lot of wealthy people in this world. And whether it be real estate or oil and gas money or whatnot, people who don't necessarily invest in what you do or in tech very often, their expectations as far as how you do business or what your returns will be or when they will actually show up on their doorstep can be very, very different than those angels who routinely invest in tech. So finding experienced angel investors who actually do invest in your space, who can add value, and who can also maybe introduce you to people like Robert or other people in the industry at venture firms for your next round is really, really key. And I can't emphasize enough how important it is to be choosy at the angel investor stage. I think all money is not good money is the phrase that I love to tell my clients. Your angel investor can be your biggest advocate or your 80-20 problem. So choose accordingly and choose carefully.
Awesome. Well, I know we're a little bit over time, so thank you everyone for attending this session. This was recorded, so a recording will be sent out to you all after this closes, either later this afternoon or tomorrow. And for those questions that we didn't get to answer, we will definitely try to make an answer to them, and I'll circle up with the group here or connect with some folks at Carta to help out. But again, thank you so much for attending, and to our panelists, thank you so much for participating in this. It was so great to have you all on. Thank you.
Thank you.
Bye-bye.